Good evening and welcome to another insightful episode 8 of Filter Coffee with Contest. I'm your host Shubhada Patil and I'm here to represent the view of SEBI registered RA Karthik Junagadla and the team at Contest Research. Today we'll navigate through the complex landscape of the Indian markets following the recent Lok Sabha elections. Our discussion will explore the significant investor behavior and market trends that are shaping the current economic environment. In today's episode, aftermath of the elections will be discussed, a time typically characterized by volatility and strategic readjustments in the markets will be seen. We are seeing the pivotal movements, particularly from foreign portfolio investors and domestic institutional investors, each playing crucial roles in the make markets decisions. We'll unpack these developments and what they mean for everyday investors and the broader economic landscape. Specifically, we'll look at the speculative behavior of the FPIs and the dominant role of retail investors in the options market, particularly their influence around the Nifty's critical 23,000 level. Understanding these dynamics is essential for predicting potential market shifts for investors looking to refine their strategic response to these changes. Moreover, today's discussion will also touch on how recent economic forecast and policy update, particularly from the Reserve Bank of India and global economic signals from entities like the US Federal Reserve, are poised to impact the market. Each of these elements offer unique insights into the forces driving market sentiments and investment flows. With this topic outlined, let's dive into our first segment where we break down the current state of Nifty's options chain and analyze how retail investor activities are influencing market trends. Let's focus on the Nifty's option chains, a critical barometer for gauging market sentiment and investment behavior. The option chain can provide us with insights into future market movements by showing us where investors are placing their bets. Today, the 23,000 level on Nifty stands out prominently. The 23,000 mark is psychological and strategic battleground for traders and investors alike. This level has gathered significant open interest, indicating that it's a focal point for both bullish and bearish sentiments. What makes this level particularly interesting is the heavy participation of retail investors who currently dominate the options segment. Retail investors have been particularly active and their strategy tend to sway market dynamics significantly. Currently, the options setup suggests a bullish inclination among these investors. Many are writing puts, which generally indicate a belief that the market will maintain or exit this level, thus allowing them to profit from premium received against a backdrop of stable or rising prices of the index. Option writers, especially those dealing in put options at the 23,000 level, are essentially betting that the market will not drop below this point. This activity can create a self-fulfilling prophecy. As the market approaches this level, the writers of this option have incentives to buy underlying assets to put the market up and prevent their options from going into the money, thereby stabilizing or even boosting the market. The scenario is crucial for understanding the potential market direction. If the market sentiment remains strong and economic indicators support growth, we could see the Nifty shift pushing above this pivotal level. However, if underlying weaknesses start to surface or if there are shifts in broader economic policies or global conditions, this level could be tested. Should the market break below this, it could trigger a rapid unwinding of positions leading to increased volatility. In essence, the Nifty's 23,000 level is a significant indicator of market sentiment dominated by retail investor strategies. Monitoring this level and the behavior around it gives us vital clues about the market short-term movement and investor confidence. So, with a deeper understanding of the dynamic at play within Nifty's option chains, let's shift our focus to the broader economic forecast and market sentiment following the elections. How are these factors influencing investor behavior, and what can we expect in the coming months? Stay tuned as we explore these questions in our next segment. The conclusion of Lok Sabha election has brought a certain level of clarity and stability. Anticipated by the markets, investors have been closely watching for signs of continued policy directions and any new initiative that might impact economic growth. The government's return has been generally viewed favorably by the markets, as it suggests a continuity in economic policies and reforms which have been crucial in driving growth. A pivotal development was that the Reserve Bank of India's recent upward revision of the GDP growth forecast for the fiscal year 2024-2025 from 7% to 7.2%. This adjustment reflects a stronger than expected rebound in domestic market, which is crucial in driving economic activity. The RBI's optimistic outlook is based on several factors, including improved consumer confidence, favorable monsoon forecast, and robust government spending on infrastructure. This positive revision has buoyed the markets, instilling confidence amongst investors about the health of Indian economy. A stronger GDP growth forecast typically signals robust economic fundamentals, encouraging both domestic and international investors to increase their market participation. This is particularly significant in sectors expected to benefit directly from economic upswing, such as consumer goods and retail. The sectors are likely to outperform in this evolving economic scenario include FMCG, pharma, and IT. The sectors are known for their resilience and are often less volatile in uncertain times. Additionally, they stand to gain from increased consumer spending and accelerated digital transformations in the West. Meanwhile, the infrastructural push by the government is poised to benefit the real estate and construction sectors, creating a ripple effect across related industries. Given these positive indicators, the general market sentiment is optimistic. However, investors are advised to remain cautious and vigilant. The global economic environment remains fluid, with potential shifts in monetary policies by major central banks, including the US Federal Reserve, which could impact capital flows and exchange rates, influencing market dynamics globally and domestically. With a better understanding of how recent economic forecasts are influencing market sentiment, let's now look at the global economic trends, particularly the decisions by the US Federal Reserve, and assess their potential impact on a market. This understanding is crucial for strategizing in an interconnected global economy. After examining the domestic economic forecast and the implications on local markets, let's expand our view to global stage. In this segment, we will explore key global economic trends, focusing on recent decisions by the US Federal Reserve and their potential impacts on emerging markets, particularly India. Globally, economists are navigating through a complex landscape market marked by gradually recovery from the pandemic disruptions, geopolitical tensions, and inflationary pressure. The US Federal Reserve's monetary policy decisions play a crucial role in shaping this environment, influencing global investment flows and currency exchange rates. This Wednesday, the Federal Reserve is expected to maintain its interest rate in the range of 5.25 to 5.5%. This decision is significant as it indicates a continuation of Fed's strategy to manage inflation without stifling economic growth. Higher interest rates in the US generally lead to a stronger dollar, making US assets more attractive, but they also have the effect of pulling capital away from emerging markets. For emerging economics like India, the Fed's decision to maintain rates could have mixed implications. On one hand, stable US rates prevent further strengthening of the dollar against emerging market currencies, which could ease pressure on the economics. On the other hand, sustained high rates in the US could limit the flow of cheap capital to emerging markets, which rely on foreign investment to fund growth initiatives. Looking ahead, if the Fed signals any potential rate cuts later this year, it could lead to increased capital flows into higher yielding emerging markets. Such a scenario would bolster foreign investments in Indian equities and bonds market, potentially strengthening the rupee and boosting market sentiment even further. Conversely, prolonged high rates or any unexpected rate hikes could create headwinds for Indian markets by attracting capital back to US assets. Indian investors need to stay alert to these global trends. Any understanding of Fed policies will help in strategizing for potential currency fluctuation, changes in foreign investment patterns, and overall market volatility. Additionally, sectors like IT and pharmaceuticals, which have significant export operations, might see varying impacts based on the strength of rupee and global economic conditions. As we navigate these uncertain global waters, the interconnectedness of economies underscores the importance of keeping a keen eye on international developments. By anticipating and understanding these global economic trends, investors and policymakers can better prepare for the resultant effects on domestic markets. With our explorations of global economic trends and their implications completed, we conclude today's episode. This insight into how international decisions affect our local markets are crucial for developing robust investment strategies. Thank you for joining us for another episode of Filter Coffee with Contest. We hope today's insights into post-election market dynamics and global economic trends have provided you with very valuable perspectives for navigating the complexities of the financial world. Don't forget to like, subscribe, and share your thoughts in the comments below. Your engagement helps us bring more in-depth analysis and discussions into this platform. Keep an eye on these developments, stay informed, and most importantly, apply this knowledge to make strategic investment choices. Follow us on social media to stay connected with a community of informed investors like yourself. Until next time, keep brewing your investment strategies along with your coffee.